Mutual fund fact sheets are one of the most famous and important documents which most of the mutual fund companies publish every month. And in case you have not gone through the fact sheets of mutual fund companies or you are new to mutual fund industry, then this video is going to help you in familiarizing yourself as what mutual fund fact sheet is. But more importantly, you are get to know that what all information you should look into it in a mutual fund fact sheet. Hello everyone, I'm Shobhit. I'm a FinBiz growth expert and a founder of FinBiz Growth Club. We are a community of aspiring mutual fund distributors who are determined to change the way India invests. So coming back to a mutual fund fact sheet, what is this fact sheet? It is a booklet which will have all the information related to all the mutual fund schemes of a particular mutual fund company. So if you are looking to invest in any scheme and you want to know the basic details as where the scheme is investing, who is the fund manager and all the technical and non-technical parameters, then you should look into the mutual fund fact sheet. Mutual fund fact sheets are generally published every month by most of the mutual fund companies, and it is very important for you to look into it in case you are mutual fund distributor or if you are aspiring mutual fund distributor. It is a very important document or a booklet which you should refer to. So I am going to dive into one by one as what all things you should look into it in the fact sheet to be well informed and more importantly help you in picking better mutual fund schemes for your client. So the first important thing which you should be mindful of is the market outlook or macro outlook which most of the mutual fund companies publish in their report or in their fact sheet. So the first important thing or numbers which you should look into it is what is the various index performance. Now I have taken a screenshot of ICICI Prudential fact sheet. You can take any mutual fund fact sheet and most of the fact sheets will have these informations. So what you need to look into it, which are the indexes which has performed very well in the last year or so. So it is going to give you an broad view that which sectors has been performing well, which sectors has been laggard, and you can take an informed decision that which kind of portfolio you would like to go into it, whether you would like to ride the trend and invest in those portfolios which are already heavyweight on those sectors which has performed well, or you are a value advisor who would like to go with those sectors where it has not performed so well. So this is going to give you that insight. Other important number which you should look into it is the FIIs and DIs number, how they have been investing over a period of time. Now, why we should look into this number? It is going to give us an overview as whether the big players in the market, those who have billions of dollars, whether they are bullish on the market or bearish in the market. So in case they are buying on month basis, it means the inflows from FIIs, DIIs or mutual funds are on a positive territory. It means we are on a positive trend and markets are likely to go up. But if the trend is in negative, it means all our big players are selling in their investments. It means that the market is looking bearish and you should also be cautious while investing in the market. So these two are the macro factors which I would like you guys to see in every month fact sheet to get the insight as how you are going to take decisions while selecting a portfolio for your customer, and also get the major trend as how this market is behaving or how the stock market is behaving in terms of the major players where they're buying or selling. Now I find one very good pictorial insight which is being published by ICICI Prudential Mutual Fund. So they give you an overview depending upon the major parameters like P ratio, price to book value, as whether the equity market is overvalued or undervalued. So they take lot of parameters, and based upon those parameters, they have built this chart which will show you whether the market we should invest in or we should be cautious. So if you look at the recent trend, if the graph is in the green, it means market is undervalued and you can invest in. And if this graph is going into the red territory, it means that you should be cautious. So they have taken multiple data points to come to this conclusion, and it should be a fair indicator for you as whether you should be investing or you should be cautious and look into a portfolio which is not overweight in the stock market. So this is also one of the good parameters which you should look into it. Other important thing which you should be mindful of is the taxation. Now in mutual funds, the most important factor which I believe is the tax arbitrage which you are going to get. Most of the equity schemes and debt schemes will have a very tax efficient returns compared to other investment classes. So you should be hands-on with what are the tax which a customer has to pay either on short-term capital gain or long-term capital gain. So I find in Birla fact sheet where every month they are publishing what is the various tax angle for various schemes. I would highly recommend that you should be hands-on on all the tax angle. What is the tax the client has to pay if he's investing in equity, what is the tax the client has to pay if he's investing in debt, what is long-term capital gain, what is short-term capital gain, and all those things. If you want to have a ready reference, I would highly recommend that do visit Birla Mutual Fund Fact Sheet, where you are going to get all this information, and that is going to help you in getting deep insights into the taxation part of mutual fund schemes. Now, one another thing which I would like you guys to dive into it, that there are a lot of technical jargons you are going to find in the fact sheet, but I want you guys to be hands-on on those numbers and the technical ratios which are going to be presented in the fact sheet and various schemes. So if you are not very comfortable in those things, I would highly recommend that do visit the glossary pages or the explanatory pages of mutual fund fact sheets. So you will find the terms like yield to maturity or modified duration or standard deviation or Sharpe ratios. So these are the technical numbers which you should be well aware of, and you should be hands on this. These parameters are going to help you in getting more familiar with all these numbers, which is going to help you in picking better mutual fund schemes for your client. So you should not be afraid of these names. You should be diving. There are very simple definitions which most of the fact sheet will have. What is beta, what is Sharpe ratio, what is turnover ratio, and so on and so forth. Believe me guys, if you are able to get handhold of it, because most of the schemes and most of the mutual fund fact sheets will be reflecting these numbers, you will be able to take informed decisions regarding your client. So just be mindful of that. So these are the macro things which are common to all and every fact sheet. I would like you guys to first get hands-on. So once you are hands-on on this and it is going to give you all the insights which you require, then now let's discuss what are the various numbers which you should look into it if you are going to pick equity schemes for your client. What are the various numbers which are present in the fact sheet which is going to be important for you if you want to pick a good mutual fund scheme for your client. So the first thing which I would like you to dive deep into it is see who is the fund manager. And why I want you guys to look into that. If you are of the camp and believe that race is won by the driver and not by the car, then you should be very mindful of who is managing the fund. So the parameters which I would like you to understand and dive deep into it is, see who are the fund managers and what are their credentials. More importantly, how long they have been managing that scheme. That is also going to be a very important factor, because that is going to give credentials as how they have been able to manage that scheme. Try to correlate from the time they are managing vis-a-vis the performance of the scheme to get a fair idea as how they have been managing and what you can expect from them in the future. The next important thing which I would like to dive into it is, see from what date this scheme has been launched, or till what time period this scheme has been in the market. That is also going to be one of the important factor. I would recommend that you should be looking into the schemes while selecting for your client to have at least 3 to 5 years of track record. Other important number you should look into it is, what is the total AUM of the scheme. Now, why you should look into it? First, it is going to give you a credential that fund has been doing good. That's why more and more people are investing. And also, if you are a mutual fund distributor, you should be very mindful of the fact what is the total size or total AUM of the scheme. Remember, the expense ratios which a mutual fund company can charge on the scheme would be directly proportional to the AUM of the scheme. So higher the AUM, lower will be the expense ratio, and lower the expense ratio, lower will be your commission. So you should have a fine balance between the fund size and the revenue which you are going to generate. If you are not able to survive, how you are going to service your client? So you should be mindful of that. Or other important factor which you should be mindful of is, what is the exit load? Because if you don't know whether the exit load is after 1 year, 6 months, or what is the rate of exit load, it may impact your client's return in case he wants to withdraw an emergency. You should also be mindful of what is the minimum application size so that you can give informed information to your client. So these all things we are going to be very crucial while you are selecting a mutual fund scheme. Now, whenever suppose you want to select a mid-cap fund for your client, I would like you to refer to 2-3 mutual fund companies fact sheet, look into these parameters, and then select one of the scheme which you think fits in all these parameters so that you can take an informed decision for your client. Now, if you do your homework, you will be more confident that you have selected and given a good scheme to your client. Now, talking to another important factor, I would like you to see a lot of quantitative indicators for the equity mutual fund schemes in particular. Now, the first thing which I would like you to consider is, consider the annual portfolio turnover ratio. Now, this is what? This is going to tell you how often the fund manager is buying or selling a stock. Now, higher the turnover ratio, it doesn't argue well for the mutual fund manager, because it shows that he's not very sure about his stock selection. Now, if you're buying a say sectorial fund or a thematic fund, this ratio can be little higher because the fund manager would like to time the buying or selling. But if you're buying a portfolio which is diversified and the turnover ratio is high, it doesn't argue well. It increases the expense also of the scheme, and it also shows that fund manager is not very clear on his thought process. Now, other number which I would like you to consider is the standard deviation. Now, what this says, the standard deviation is going to give you a fair bit of idea what would be the volatility in the return in the future compared to in the past. So if a scheme is having a higher standard deviation, this means that the future returns of the scheme would be more volatile compared to that scheme where the standard deviation is much lower. Again, please remember, compare apple to an apple. This means suppose you are comparing a large cap fund standard deviation, you should compare with large cap standard deviation of the other scheme. It should not be that you are comparing a large cap fund standard deviation with the standard deviation of a mid cap fund. So I hope you are going to do that. Just see if you're shortlisted 2-3 schemes from the same category. It makes a lot of sense to select a fund which is having a lower standard deviation, so that in future the volatility in the performance would be much lower. Other ratio I would like you to consider is the Sharpe ratio. Sharpe ratio is going to give you an indication what kind of risk the fund manager is taking to deliver the return. Now, in a technical term, this ratio defines what is the return the fund has generated by per unit of risk it has taken. Now, if in a layman language, we can say higher the Sharpe ratio, better it is for the scheme. So you need to look into a scheme which is having a higher Sharpe ratio, so that you can understand that by taking lesser risk, the fund is able to generate higher return. So please look into this parameter. Other important thing which you need to look into it is, in any scheme, is look into the various sectors in which the fund is investing. So just to give you an example, suppose you are looking at this scheme sector allocation, you can find the banking is having the high sector allocation, and software, and so on and so forth. Now, as I have discussed with you in the beginning, that you need to look into which sectors have performed well in the last 1 year or so. So if our banking sector has performed well and my scheme is also overboarded in that sector, it means that we are riding a cycle which has already been played out. I would personally prefer a scheme where the allocation in one sector is more, which has not run up too much up till now. So these all numbers are going to correlate for you. Look at which sectors have performed well, and in this sector whether those have been overboarded, or in this fund whether those sectors has been overboarded or under played. It is going to give you a much more comfort, and your own understanding would be much more better. So these all things you should look into it while you are studying the portfolio and selecting a mutual fund scheme for equities. Now let's dive into the debt. What all things which you should look into it if you are going to select a debt scheme, and what all information you need to pick from a mutual fund fact sheet. The first thing which I would like you to consider, and which is very important for all of us, is to see what kind of portfolio the fund manager has chosen. When I'm talking about the kind of portfolio, I want you guys to look into the quality of the portfolio in debt and not the other way around. So when I talk about quality, what I mean, you should look into the ratings of the various securities which the fund manager has bought to make the investments, or fund manager bought in the portfolio. So if you look at this example, you can see the ratings of various papers which the fund manager has bought. In this, if you see, the fund manager has bought sovereign papers, CRISIL A plus papers, and other papers which are triple A, double A, and so on and so forth. Now, this is going to give you a fair bit of indication what is the quality of companies in which the fund manager invested the money of the scheme. Now, if you find lot of papers which are double B's, triple B, single B, and so on and so forth, or single A, it doesn't argue well, because the fund manager is taking a undue risk. Now, if you see downside, you can see in the AAA and equivalent, the fund has invested 46% of the money. In sovereign, the fund has invested 37% or more. So in net, you can see majority of the money is into the quality paper, and that is going to give you a lot of comfort in terms when you are advising your client. Avoid those portfolios where the fund manager has taken undue risk, or has given importance or overboarded on lower rated papers, because it is going to create lot of risk for your client. Now, talking about technical numbers which you should look into it while selecting a debt portfolio, is you should look into the average maturity. Now, in fact sheet, average maturities are very prominently highlighted. What I would like you to understand regarding average maturity is the average maturity gives you an indication that what is the weighted average maturity period for the portfolio. So some schemes will be maturing, some securities will be maturing in say 1 year, some securities will be maturing in 60 days and so on and so forth. So what is the average maturity or average weighted maturity of the paper? So in this example, if you see the average weighted maturity is 40.82 days. It means if we are going to invest in this paper, the average securities in this paper are going to mature in this many days. Now, I would like you to understand this. If you are going to select a scheme from a particular category and a scheme is having a lower average maturity, that is going to argue well for you because you are not going to take a higher risk. Higher the maturity period, higher is the risk. So if you are going to get money in 30 days and if you are going to receive money in 80 days, obviously the 40 days if you are going to get your money, that is having a lot lesser risk. So if you're planning for an investment for a client who is going to invest for 30 days, in this case 40-day average maturity scheme would make lot of sense. So just if based upon the time horizon of client's investment, average maturity can give you lot of insights. Other thing which I would like you to consider is the yield to maturity. Now, what is yield to maturity? Yield to maturity is what the return the client can expect if he is going to hold this investment for the average maturity period. So in this example, if the average maturity is 40.82 days and yield to maturity is 3.29%, it means if you are going to invest in this scheme for 40.82 days, you can expect a return of 3.29%. So if you are selecting a scheme from in a particular category, in those categories, see whether the yield to maturity is higher and average maturity is lower. So you need to find a fine balance. Obviously, if the higher the average maturity, higher would be the yield to maturity because higher the risk, higher the return. Other important thing you should also look into is the modified duration. Now, modified duration is going to give you an indication of how sensitive the performance of a debt scheme would be according to the changes in the interest rate in the market. Same way the macro durations. These two things are going to give you the sensitivity of the or volatility of the returns of the scheme depending upon the change in the interest rate in the market. So you need to be mindful of these numbers and always compare it. These are the relative numbers. If you are selecting a short-term fund, take 2-3 short-term funds, see whether the yield to maturity for which scheme is higher, what is the average maturity and what is the modified duration. Lower the modified duration, it will make lot sense for you to pick that scheme. Higher the yield to maturity, it will make lot of sense for you to pick that scheme. And average maturity also should be considered in case you are planning to invest for your client for the particular time period. Now, other important thing in nowadays have become lot more important is to see whether in that scheme there is any segregated portfolio. Now, what is segregated portfolio? Segregated portfolio is a portfolio in which the borrower has defaulted either in paying the principal or interest on time. So that is also been highlighted in the fact sheet and you should look into it. If in case any scheme has a segregated portfolio, which means the borrower has not paid either interest or the principal on time, you should avoid those kind of a portfolio. Okay, now here also you can see the Fund fact sheet have highlighted how much they have invested in what kind of papers, and then you will be able to see and you will be able to take an informed decision on that. I hope you got a great insight that what all numbers and parameters you should look into it while you are selecting a scheme by seeing in these fact sheets all these informations. Believe me guys, if you keep on reading fact sheet for 4-5 months, you guys will be much different mutual fund distributor vis-a-vis what you are today. And in case you are aspiring to be a successful mutual fund distributor or you would love to dive into this profession by helping others. If you want to generate lot of wealth for yourself, then I would love you guys to join my 90 minutes free masterclass. In that masterclass, I am going to discuss with you how you can start a profitable mutual fund distribution business in 21 days or less. Do join me for the masterclass. I'm going to leave the link for the masterclass in the description. I would love to see there live. Now, in case you like the content, do give a thumbs up, subscribe to our channel, do share with your family and friends, and I would love to see in the comment box what was your biggest takeaway. What was your the best learning from this video? Just type in the comment box. I would love to see what was your biggest takeaway from this session. Thank you for joining in. I am going to see you next time.